This is Jeremy Gresham, a principal of Scaffold Partners. Today's webinar is on passive investing in real estate. For our discussion today, we have Dave Castellani and Dan Joseph. Hello, Dave. Hello, Dan.
Good morning.
Jeremy, good morning.
David Castellani is an operating principal of Brewer Lane Ventures, a fintech-focused firm located in Boston, Massachusetts. Previously, he was a senior vice president and head of technology at New York Life, where he was also on the executive management committee. David's co-founded two tech companies, one of which was sold in 2006, and he's been investing in commercial real estate for the past 10 years. Dan Joseph is a founder and principal of Corridor Ventures, a real estate investment platform that invests in, owns, and operates multifamily and student housing properties, as well as alternative investment vehicles. Dan is also the co-founder and chief investment officer of Apparent Capital, a Corridor-led go-anywhere real estate investment company. In almost 20 years, Corridor has completed over 60 real estate acquisitions worth about $650 million, raised over $150 million in equity, and owned 8,200 multifamily and student housing units. We'll be covering 5 topics in today's discussion. Why invest in private real estate? Why not just buy REITs? What's the strategy for investing? Choosing sponsors, choosing deals, and how are you approaching real estate investing today? So Dan, why don't you kick us off with why invest in private real estate? Why not just buy REITs?
So the first thing I would say is if you can access private real estate opportunities through trusted partners, historically, it's been a better performing asset class overall than REITs have. REITs have outperformed the S&P 500 over the last 40 years by about 200 basis points. Privately held private equity real estate has outperformed that by approximately 400 basis points. So from a return standpoint, privately held real estate historically can be bought at more attractive prices than REITs can be, at which REITs can be purchased. You have a manager keeping their eye on improving that property, managing it, making sure it functions well. Additionally, you get tax benefits right out of the box because the properties that are purchased are depreciable, and those depreciation benefits accrue to the benefit of the investor. And finally, cash flow is typically generated somewhere in the 5 to 10% range right out of the box against your investment in that privately held real estate asset, whereas good, reliable REITs typically generate somewhere between a 3 and 5% profit margin from a cash flow standpoint. So that's kind of the basics of it. What I would say is a good portfolio would have both. Publicly traded REITs are valuable asset class. They can be bought also at attractive prices because they're overreactive to market sentiment. And that is a very good way to get into asset classes that are opportune when it may be very difficult to get into private assets that are opportune at the same time at the same values. So, I'm certainly a fan of allocating capital to both public and private real estate. But as an owner of private real estate over the last 20 years, I can tell you that, our firm has generated internal rates of return, meaning compounded rates of return over 20% on the average, which is very strong when you compare that to some of the best REITs and their returns over that same time frame.
Dave, what's your take on why investing in private real estate versus REITs?
I mean, I do both, Jeremy, but I sort of look at my investing and try to put as much as I can in illiquid investments as possible. And the reason for that is you get paid for your illiquidity. And when I look at illiquid, I've got venture because I'm part of Brewer Lane. I've got some private equity in businesses, and that represents about 40% of my illiquid holdings, in 60% in real estate through Corridor. Actually, I love the yield, love the cash flow. I get paid while I wait. It's tax efficient as you go along the way here. But it's also less risky than these other investments. And so it's a nice complement to my illiquid portfolio. The main reason I like illiquid is I tend to fiddle with my investments, and I can't do it here as well. I have to salt that money away, forget about it, allow the professionals to handle it. I can't get nervous about the markets. I can't do anything about that. When I'm starting to look at my Schwab account, day in and day out, I'm awfully tempted to make decisions about that often aren't the right decisions long term. So I really, really love long-term investing, illiquid real estate as the main, component piece of the illiquid portfolio. I've often been questioned by people saying, well, I own my house. And I said, that's not real estate. I mean, it's real estate, but it's an expense and it's a place to live. And it's unlikely you're going to trade your way out of that just because some good offer comes along. So I take that and I put that over here and I ignore it. I just don't look at it as an investment because you got to have a place to park yourself. And so I think that's a specious argument when you start looking at your investment portfolio.
I agree with that. A lot of people will say, I don't want to invest anymore in real estate. I'm very heavily levered to my own personal real estate. I have, a house in Westchester and I have a home in Palm Beach, and we're thinking of buying something in Aspen. None of that real estate, although the world has changed now that Airbnb allows one to market their privately owned or personal real estate for public consumption, I still feel like it's a less strong argument than real estate that is designed to be income producing.
Right.
Let's move on. Dave, you already started to talk about this, sort of your strategy for investing, within an overall portfolio. How do you allocate on a deal by deal basis, and then deal by deal versus fund? So let's touch on some of the strategy issues around investing, if you would.
I mean, a lot of your strategy investing is to have an overall plan, which is to say, these are the overall percentages I want in the various asset class. So I started talking about liquid versus illiquid. Within the liquid portfolio, you'd say, well, how much do I want in growth and how much in value, et cetera. And, I really believe in rebalancing to the extent you can. In the illiquid side, it's mostly opportunistic for me, meaning I like the deal that's being presented to me, and I've got the cash on the sidelines that I wish to salt away. And so that sort of dials up and dials back how much I would participate in any given deal. But to be honest with you, I think you have to trust your advisors, your money managers in this situation. In this situation, Dan knows 100 times more about equity real estate than I'll even understand. And so if it's good enough for him, it's good enough for me. And the thing I like about Quarter, I'm sure we'll get into this in a minute, is they've got skin in the game. And I always want to be with an investor who's got the same sort of skin in the game as I do.
Dan, do you want to comment on that?
I mean, that sums it up. Skin in the game is essential. First of all, I would not feel right about taking money from other people, right, without having skin in the game, right? If they're going to lose money, I'm going to lose money. But the same applies as an investor. It's really one of the first things I look for. And Jeremy, that because we're in the process, you and I, of negotiating a deal with a potential self-storage partner. And you've heard me talk in that context around skin in the game over and over and over. It is critically important to me that anybody I invest with will lose money alongside me, will feel the pain alongside my pain in the event something goes wrong, and things can go wrong. It's just you don't want a scenario where there isn't alignment between the sponsor of the investment and the investor.
And Dan, how do you go about allocating on a portfolio basis?
You mean between my real estate portfolio or my illiquid, or?
Sure. Dave, why don't you take that, and then Dan, you take it.
I mean, it's very simple. I try to keep 20% in venture, 20% in private equity, investments in businesses, and the remainder, the 60% in equity real estate. And, sometimes I might be 22% here and, 18% there. That doesn't really matter to me because I can always sort of rebalance. But generally, that's the sort of the way I like to structure the portfolio.
And Dan, how about you in terms of your both at the personal level, on the REIT level, private level and REIT level?
So to start with, I'm in the real estate business, is what I spend all of my time doing. I invest publicly, I invest privately, and I have multiple companies that invest in the space. So, understandably, probably 70% of my net worth is deployed into real estate in general. But more tactically, I always try to maintain liquidity to invest in opportunities that come along. I never know whether we're going to do 1, 2, or 10 deals in a year. And I want to always make sure that I'm keeping an eye on my liquidity so that I can deploy capital to those opportunities. We have done a couple things at Corridor over the last few years, which are designed to guarantee that that happens. So in addition to my partner and my personal liquidity, which we will always deploy in our deals, our company has grown its balance sheet and kept money in the company and has invested in our individual deals. So our company is becoming an investor as well as a sponsor alongside us personally. And the third aspect is we've just launched a new investment company that has our own capital as well as our investment capital and has the mandate to go deploy that towards our own investments and towards outside investments. And when you combine those two things, we intend to fund somewhere in the neighborhood of 10 to 15% of the total equity requirement in every one of the deals that we do. So that's sort of the broad picture. From a personal standpoint, I'm opportunistic. I don't really think about allocations as specifically as Dave does. I do have an allocation to venture capital. I do have an allocation to private equity. It's opportunistic more than it is designed to meet certain percentages. And as it relates to real estate, I would say that I have the majority of my real estate portfolio invested in private deals. And that, again, is just more a function of what I do for a living than it is a chosen allocation. I also, over the last 6 years, I have been spending more and more time focusing on generating deep knowledge in the REIT space and the real estate public equity space. So that allocation as a portion of my overall portfolio has and is growing and will continue to grow. But the majority is private real estate, which, part of that value is value that has increased over time. I mean, because we're sponsors, there are situations where we have investments that grow in value by 7 to 15x over a period of 10 years. Because we get sponsor-related economic advantages for doing a good job on behalf of our investors. And so that as that value grows, the portion of my portfolio that's owned in private equity increases.
A circumstance we haven't spent any time talking about because it hasn't existed for a while is inflation. And, real estate is a tremendous inflation hedge. I mean, you think about it the other way. Do I want to own bonds? Do I want to sit in cash? There have been times when that's been a useful strategy, but it's certainly not now. And I don't see that ending with the government's insatiable appetite to both print, paper to fund their programs. But real estate also is a finite asset. On the other side, on the equity component for, companies that you own in terms of stocks, you don't know when they're going to issue more shares. So you don't know when you're going to get diluted. I'm not going to get diluted when it comes to equity real estate. And so I like the protection and the control that's afforded, also the cash flow that comes along with the inflation protection. It's a big deal right now.
Yeah, I think that's right. Now, you're not going to get diluted unless we screw up, which of course is possible. So just got to put that on the sidelines. But I agree with David. I think that the best asset is one that generates cash flow yield, right, which is an instant hedge or counterbalance against inflation. And the second is you want that asset to appreciate over time. So that's the perfect scenario, right? We can distribute the earnings that come out of our privately held real estate, and that does not impede the ability of that real estate to grow in value. That's pretty significant because if you look at a company, very often a company will take those earnings and be reinvesting those earnings. Now, if your capital is deployed with someone who's a really good allocator of that capital and has a really, really good model, then those earnings are better deployed back in the business. But I would posit that an asset that is designed to both appreciate and generate cash flow is going to have a pretty strong net asset value benefit over the course of time.
Dave, I know you choose sponsors. Dan, for you, I would ask you talk about the JV sponsors that you choose to work with. Dave, can you start with how you choose sponsors?
Yeah, I mean, it's the same way when we think about venture investing at Brewer Lane. It starts with people. You believe in the entrepreneur. Do you believe in the management team? Do they have enough experience? Do they have the right vision? Do they have the right self-control? Those are all really important. I actually met Dan on the golf course. And it's funny in a way, but you can learn so much about an individual in 5 hours on the golf course and how they comport themselves through a whole set of different adversities that present themselves as you trundle along in the miserable game that we play. And so, after 3 or 4 rounds with Dan, I said, this is a good guy. Now, what's his team?
He doesn't cheat.
He doesn't.
He lets me win.
No, you never let me win. But no, I mean, do guys throw their clubs? As Dan said, do they cheat? Do they make excuses? How do they handle adversity? What do they do under pressure when it really matters? Can they make that putt? I think those all translate into business. So to the extent you get to know somebody, that actually creates this bond of trust. And I cannot think of any investment I've made where trust wasn't at the top. It's the most important thing going. So then the second thing for me was, okay, track record and scar tissue. Have they been around the block a number of times where they've experienced failure, difficulties, gone through difficult market cycles? I look at the last 20 years, investors have had the wind at their back. Well, what happens when the wind turns in your face? Do you actually have that kind of experience? The third thing is, what is their thesis? Do they actually stay style pure as they go along, or do they whimsically chase other opportunities that are outside their box? Maybe the fourth thing is communication. Not so much can they communicate with me, but can they communicate with my spouse? Because ultimately, I may not be around, and can they take something that is relatively complicated and make that consumable to somebody who's maybe not as financially literate? And then the last part of it is, where does this fit into the rest of my portfolio holdings? Those are, I think, the 5 key things for me.
Great. Dan, how do you go about choosing a partner to venture with?
So much like Dave, it starts with trust and integrity. That is everything to me, because I think that there is a wide band of integrity. I don't think that most people who are sponsoring investments and taking in capital are Bernie Madoffs or thieves, right? So I think for the most part, people have, a standard level of integrity. But I think there's a difference between an okay level of integrity and the highest level of integrity. And I can point to examples of people who have sponsored capital that I have invested with, for whom there's a difference between really wanting to stick to the highest standard that they can find, or trying to make excuses or rationalize why their standards should be lower. And I search for that while I'm going through the process of evaluating a partner. So I want to make sure that I get on the same page and really, really align with that JV partner and try to convince myself through a lot of questions, a lot of kind of preliminary work together, that they are going to be a high integrity partner. And then in the end, I can't determine that unless I take a chance. So again, going back to this partnership that we're in the process of negotiating right now, I have confidence that we're investing with people that have a high level of integrity. I'm pushing them in the negotiations of our joint venture arrangement to make sure that they get how important having a high level of integrity is, that the investor needs to come first before we get our benefits. And if I see that falling into place, I think that they understand and that they're willing to do it. Now, of course, they could be doing that out of a sense of desperation. I need to flush that out as well. So integrity is absolutely everything to me, number one. Number two is I want the people that I invest with to be smart, thoughtful, have capacity to really understand the numbers, have the capacity to understand markets, the dynamics of competition, the various things that can positively or more importantly, negatively impact a piece of real estate, I want to make sure they have a plan and a thoughtfulness around management and how the property that they're purchasing or investing in is going to be operating or is going to be operated both in good times and in bad. Again, to Dave's point, like things will go bad. We've had a 20-year or at least a 13-year cycle of growth in real estate where, it would have been very difficult not to make money if you were doing it reasonably right. I don't believe that the next 20 years or the next 15 years will be the same steady, predictable growth. You're going to have to be better in the next 15 years than you were in the last 15 years. Otherwise, you will get hurt. Again, Dave mentioned this, but I would agree. Communication is really important, really important. You want to know that the people who you've invested with, that the alignment is there, that their expertise and their commitment is there, and that they communicate openly, honestly, and fully to you as an investor and regularly. And there are cases where we've invested with people, I've asked the question, and their communication wanes over time. So, maybe the first quarter that I get the distribution, it comes along with a letter, and maybe the next quarter they skip the letter or provide less detail. The quarter after that, it gets a little bit less of a priority for them. Maybe the investment starts to weaken and they start to think to themselves, well, we're not going to make as money on this deal. We may as well focus on the new deal and the new investors because, maybe Dan won't continue investing with us and, kind of push me off to the side or consider me less of a viable source of capital in a future deal. Like that's where somebody's integrity comes out. So to that point, Dave would not have, laid it all on the line with me the first time he invested with Corridor, right? He had to see how I operated around all these things. He had to spend time with me, personally on the golf course, on the telephone, hearing how we're thinking about some of the things that we're dealing with. I mean, I actually remember, I'm not even sure if this was before Dave started investing or not. We were dealing with a troubled asset in Illinois, and Dave and I were on a trip to Nantucket together to play golf. And I was telling Dave about our troubles with this asset. And, it was out there in the open. And so he had a chance to really get inside my head to understand how we were thinking about dealing with a difficult situation. And so I think you can't really get full experience with a partner in any other way than doing it over time. So you take a chance, you make a small investment, you watch that person work, you get to know that person better, you develop a closer relationship because you don't need to have 10 sponsors or partners with whom you invest. You need one or two really, really good ones. And if you slowly get to know them and can convince yourself that they are good, they will provide you with a steady stream of opportunities for the rest of your investing life. And you'll always know I can allocate, X thousands of dollars or hundreds of thousands of dollars per year to this person's deals. They will present me with good deals. They'll be thoughtful about the way they present them, and they'll operate them with integrity.
Jeremy, at Brewer Lane, we have this evaluation when we look at companies. We want to deal with nice people who have a soul. Now, that doesn't mean you can't be tough, but you care. Life's too short to deal with, what. Yeah. And so if you can find people who are highly competent and skilled, but also have the right compass, it's easy. You can talk to those people, you can reason with those individuals, you can have honest conversations. There's a level of transparency. Dan's right. I learned a lot about what Corridor could do, on behalf of my money relative to how he handled problems. Everybody's a really nice guy when things are going great.
Terrific. Let's move on. Dave, you've chosen the sponsor. How about choosing deals? Can you speak to how you choose one deal versus another deal?
Yeah, I really don't. I rely on Dan and his team to come up with the right deals. I've gone through them. I've gone with them through a number of market cycles to, build that level of trust. Dan mentioned the first couple of deals I did with them. I think I probably went pretty light in terms of how I sort of entered in. But over time, as my comfort grew, I began to be a little bit more interested in what they were doing and put more money with them. But I don't actually look at the deals. Like if he pops a deal and says, this one's in Florida, this was in Texas, what do I know? It's not what I do for a living. It's what they do for a living. And so, you know, eventually when you have that full faith and trust in your team, you let them do their thing. And so for me, it's predicated on, what does my cash position look at that time? What do my allocations look like? And if I've, you know, got enough money to put in that particular opportunity, I'll go ahead and do it. But I don't think I've missed many, Dan, in the last couple of years, because I've got a sort of a different rhythm going with Quarter that allows me to participate in everything that's going on. And you've also produced a lot of cash flow in terms of, you know, deals being sold and the normal cash flow that comes in off the deal.
So Dan, why don't you take that one also?
I'm going to take that one. It's a really great question. I think that Dave has been really true to that approach, which is if he has cash available, he doesn't focus on the deal. He has focused and had done his work on us, and now he has the experience, right? So he may ask questions. We have some interesting conversations around some of the stuff that we're doing. I have great respect for Dave. I pick his brain about things, whether or not I know more about them than he does. I value his wisdom and his counsel, right? But we do know our business. And, you know, I have investors that spend more time than they should on evaluating whether or not they should do a deal, as opposed to coming up with their allocation strategy and do the work that they should to understand who we are before they invest with us. So the worst question, or one of the best questions, let's say, I get from an investor is, do you like this deal, Dan? How do you like this deal relative to others that you guys have done? My answer is always the same. Every single deal we look at meets my criteria for risk versus return. I believe in every single deal that we do. Otherwise, I wouldn't do them. You have to know that behind the scenes, we're looking at hundreds and hundreds of deals a year, and we choose very few of them. So when a deal happens, we have great confidence that that deal is going to be a successful deal. And I would say we have a 95% success ratio in predicting the deals that are going to be good. When somebody comes to me and asks me those kinds of questions, it gives me an opportunity to advise them, which I do, to say, I think you should spend a lot of time focusing on getting to know us and making sure that we operate, behave, think in a way that you're comfortable with. Once you're past that point, I would take a pot of capital, I would divide it by 5, and I would invest equally in the next 5 deals that we do. You can ask me questions and get to know the deals, but don't try to outthink the experts, the people who are spending all their time doing it. Just invest an equal amount in those 5 deals. If you're then comfortable with how that's going, you can increase your allocation for the next 5 deals, or you can continue to allocate for the next 5 deals, or you can wait till the deal is realized, and then you can recycle your capital into more deals. But, you know, take an allocation, take an amount of money you're comfortable investing in that asset class, divide it by 5, do the next 5 deals. Don't question yourself, or don't question your manager.
I mean, you wouldn't look at Warren Buffett in the eye and say, why did you invest in this particular deal? What are you thinking of?
Individual deals go bad, right? Again, our success ratio is not 100%. We have lost money personally, and we have lost money on behalf of our investors. I don't say that proudly, but I say it openly. Like, I haven't made my last mistake as a deal sponsor. That being said, nobody has lost money by investing in 5 consecutive deals. Nobody has not made money by investing the same amount in 5 consecutive deals. And I would posit that nobody has made less than a double-digit return by investing the same amount of money in 5 consecutive deals. So,
you know, Dan, to that point, in venture, for every 10 deals, you're looking for 3 to hit. So the risk pattern there is way, way different. But it's exactly what you're saying is, if you looked at every single deal in isolation and said, boy, this is the one I want to make money on, bad strategy.
Yeah.
Okay, our last topic is how do you approach real estate investing today in terms of planning going forward, trend analysis, that type of thing? Dave, Dave, why don't you kick that one off too?
I mean, I think Dan is right about this. The whole world of investing will get more difficult in the next 10 years. We've had a pretty easy time across virtually all asset classes. And so for me, again, it's the experience and the track record and the adherence to discipline that matters the most in the end. And I want people who have gone through enough of these market cycles to actually protect me when things get more difficult, but also make really, really smart decisions. That's really it for me.
Great. Dan?
As investors, we have a general strategy that involves planting seeds and harvesting our crops every single year. So if we've done our job well, we have invested in 3 to 5, sometimes more assets every single year. And when we get to periods like we're in right now, where prices for real estate assets are sky high, and there is so much money chasing a scarce asset class, meaning real estate in general, but multifamily, which is our bread and butter in particular, you end up in a position where as an owner and an operator, someone who's been in this business for a long time, I see a scenario where people are paying more for than what something is worth, something we have. So if people are willing to pay substantially more today for something that we own, and we can generate a really great win for our investors, a really great outcome for our investors, they grow their war chest, right, for investing in future deals. We grow our war chest for investing in future deals. We achieve these realizations, and we can, continue to do what we're doing, which is we believe we can plant 3 to 5 seeds every single year, good times and bad. So we stick to that approach. Sometimes that means that we will miss investing as abundantly as we could during a time where, in retrospect, it looks like we should have, right? In 2012, I think we planted like 3 seeds, and we had conversations around, should we just back up the truck and go crazy? In retrospect, yeah, we should have backed up the truck and gone crazy. Had we done that, we'd be living on an island somewhere and probably own the island. That being said, things could have gone the other way, right? Over the last 10 years, the Federal Reserve has been incredibly dovish. Interest rates have been incredibly cooperative. Capital has been plentiful. The economy has been sort of in a Goldilocks mode for most of the last 10 years. And so that's kind of been a perfect environment in which to invest. But that doesn't mean that was the only way it could have gone. That would be sort of what's called resulting, to think that that's the only way it could have gone. So, I subscribe to the strategy that you come up with an investing philosophy and approach, you stick to it. And unless, you're slapped in the face with a no-brainer back up the truck approach, you allocate slowly. Now, that being said, we are in an inflationary environment, so we have to pay attention to the subject of inflation and the subject of interest rates as we consider new investments and as we consider what to do with our existing portfolio. That doesn't make it a bad environment in which to invest. I would say it makes it an opportune environment in which to invest, because whenever there is chaos and dislocation and confusion, there are things that go on sale. And so, during a time like this, we want to be in a position where we can take advantage and purchase those things that go on sale. When you look at growth or you look at markets, we tend to look at what we believe to be good long-term trends, but we don't get too deeply into the minutia of those trends because they can reverse on a dime and we can be wrong. So, for example, a trend we really like is the migration patterns in the United States of people from the Northeast and the West Coast to places like Texas and Florida and Georgia and the Carolinas and Tennessee. So big picture, we really like that. Those markets could get overbuilt, right? But over time, if those migration patterns continue, those overbuilt markets will slow down the building. That's just a supply and demand dynamic. The product will get absorbed, and rents will increase over time and values will increase over time. So you do have to invest with a long-term philosophy and willingness. Whenever an investor comes to me after 3 to 5 years and says, shouldn't we have gotten a better return on this asset? Or when are you thinking about selling this asset? I always try to slow that investor down and say, our approach is we will own something for somewhere between 1 year and forever. And we will let markets and prices and circumstances dictate to us what we should do around those timeframes. And if the markets had not been as cooperative over the last 5 years as they have been, if they hadn't been overpaying us for what we owned to such a great extent, we'd just continue to hold on to our assets and just continue to pile on the size of our portfolio over time, and been very happy generating good, solid, growing cash flow and good, solid assets and good, solid locations, and manage the hell out of them.
Dave, any final words?
No, not really. I mean, I think it's all sort of been covered here. I love the asset class. You get paid while you wait. I've never been the type of investor to say to Dan, when are you going to go sell this? I actually like the cash that's coming out while I wait, and the capital appreciation that's building up. And I think probably the most important thing here is that you've got a group of professionals here that know what they're doing, that actually have enough experience in these various markets, because real estate is a very interesting asset, but it isn't the best asset in all locations. You've got to actually have a location strategy, which I think these guys do.
Terrific. Great. Thanks, Dave and Dan. I've been speaking to Dave Castellani, the operating principal of Brewer Lane Ventures, and Dan Joseph, one of the co-founders of Corridor Ventures. If you have any questions about our discussion today about passive investing in real estate, please reach out.